Here is a question that should bother anyone holding gold this morning. What happens to a rally when the biggest short-term buyers are not people at all, but computers? That is effectively the warning coming out of TD Securities today, Thursday the 30th of July 2026. Their commodity strategy view, reported by FX Street earlier this afternoon, is that the repricing of Federal Reserve expectations around this week's policy meeting has capped the additional upside that trend-following funds can add to gold from here. Note the exact wording, because it matters. Nobody is calling for a crash. Nobody is saying the long-term bull case for bullion is broken. The claim is narrower and far more useful. A specific, mechanical source of buying pressure has largely done its work. If you only follow the gold price and not the flows behind it, that distinction is the difference between understanding today's market and being surprised by it. Let us unpack the language, because financial headlines compress a lot into very few words. CTA stands for Commodity Trading Advisor. In practice, these are systematic, rules-based funds that follow price trends across futures markets, including gold, oil, copper, government bonds, and currencies. They do not form a view on whether gold is cheap. They respond to momentum. When TD Securities says FOMC repricing caps CTA upside, the argument is that these funds have already accumulated close to the position size their models allow at current price levels, so the marginal buying they can still bring to the market is limited. That has two consequences. First, gold loses one engine of self-reinforcing strength, where higher prices trigger more algorithmic buying, which pushes prices higher still. Second, the market becomes more dependent on genuine investor demand, exchange-traded fund inflows, central bank purchases, and physical buying. Those flows are slower, steadier, and far less forgiving of a stretched price. So what changed? The repricing refers to how interest rate markets have adjusted their expectations for the Federal Reserve following this week's Federal Open Market Committee meeting. Traders constantly price a path of future U.S. interest rates through futures and swaps. When that path shifts higher, meaning fewer or slower cuts than previously assumed, gold typically struggles. The reason is straightforward and worth memorizing. Gold pays no interest and no dividend. Its main competitor is a U.S. government bond that does. When expected real yields, which are yields after inflation, move up, the opportunity cost of holding a non-yielding metal rises. A firmer U.S. dollar usually compounds the effect, because gold is quoted in dollars, so a stronger dollar makes the same ounce more expensive for buyers using sterling, euros or yen. Put those together and you get exactly the environment TD Securities describes, not aggressive selling, but a ceiling forming above the market. This is the part most coverage skips, and it is where the real insight sits. Trend models are typically built around price relative to moving averages, often the 20, 50, 100, and 200-day averages, combined with measures of volatility and momentum over several look-back windows. When the price sits comfortably above those averages, models are long and position size is scaled to how volatile the market has been. Crucially, once a fund is at its maximum modeled position, further price gains generate no new buying. The fund is already all in. That is what capped upside means in flow terms. The mirror image is the genuine risk. Because position size is scaled by volatility, a sharp fall through key averages can trigger mechanical selling from funds that never had an opinion on gold in the first place. Understanding that asymmetry explains why gold sometimes drops far faster than the underlying news appears to justify. In practical terms, today's setup produces a market that feels heavy rather than panicked. Price action tends to compress into a range, rallies during the Asian and London sessions get sold into the New York afternoon, and volumes on COMEX gold futures thin out because the systematic community has nothing left to do. You can watch this play out in the London bullion market, where the LBMA benchmark price is set twice each business day, at 10:30 in the morning and 3 in the afternoon, London time. Those fixes are the reference for an enormous volume of physical and institutional trade worldwide. Meanwhile, the buyers who do not care about momentum keep going. Central banks have been persistent accumulators of bullion in recent years as a reserve diversification strategy, and that demand is policy-driven rather than price-driven. It does not disappear because a Fed meeting shifted the rate path by a fraction. For a UK-based investor, there is an extra layer that dollar-focused commentary tends to ignore. Your return depends on both the dollar gold price and the pound-to-dollar exchange rate. If a hawkish Fed repricing lifts the dollar while capping gold, sterling-denominated returns can hold up better than the headline suggests, and the reverse is equally true. Anyone holding a sterling-hedged gold exchange-traded fund is taking a genuinely different bet from someone holding an unhedged one. Listed gold miners are a separate case again. Mining shares are effectively a leveraged play on the metal, because a large slice of their cost base is fixed. When bullion stalls, miners often fall harder, and they carry equity risks that bullion simply does not have, including energy costs, labor disputes, and political risk in the countries where they operate. Treating the two as interchangeable exposure is one of the most common and expensive errors in this sector. Where does this go next? The honest answer is that the near-term path runs through data rather than opinion. The catalysts most likely to reawaken systematic buying are the ones that change the expected Fed path: U.S. inflation prints, monthly payrolls, and any shift in tone from Fed officials in the run-up to the September meeting. A downside surprise in employment or inflation would push rate cut expectations forward, drag real yields lower, and hand trend models a fresh signal to build positions again. In the opposite direction, stronger data reinforces the cap TD Securities is describing, and pressure on the metal would build. There is also the geopolitical wildcard, which arrives without a schedule and typically produces sharp, sometimes short-lived spikes in demand for safe haven assets. Sensible positioning here is patience. This is a market waiting on a catalyst, not one delivering a clean, high-conviction trend in either direction today. If you take one thing from today, make it this. A capped upside is not a bearish call, it is a statement about who is left to buy. Gold's short-term price is set at the margin by leveraged, rules-based money, while its long-term price is anchored by central banks, savers, and real physical demand. When those two forces point in different directions, as they arguably do on the 30th of July 2026, you get exactly what we are seeing, a market that is fundamentally supported yet technically stuck. For long-term holders using bullion as portfolio insurance rather than as a trade, a stalled rally driven by exhausted algorithmic positioning is background noise. For anyone trading the metal with leverage, it is a warning to respect the downside asymmetry we described. Know which of those two investors you are, and today's headline stops being confusing and becomes genuinely useful information.